Today we're going to talk about what spot means. More precisely, about the spot market, spot trades, and spot prices. This is the foundation of almost all financial transactions, from exchanging currency to global oil trading. In this video, you'll learn the difference between spot and futures, how spot trades work, why they're crucial for the global economy, and how to avoid losing money when trading on the spot market. Watch until the end. You might realize you're already using spot deals without even knowing it. And don't forget to support the channel with a like and a subscription. Picture this. You walk into a store, grab a bottle of water, pay for it, and walk out with it. That's a spot deal. In finance, spot means the transaction is executed immediately. You pay, and pretty much right away, you receive the asset. It could be currency, oil, gold, stocks, even crypto. That's why it's called spot. It's about here and now. A spot trade is an instant deal with no future delivery dates. As soon as you hit buy, the money's deducted and the asset comes your way, or vice versa if you're selling. Still, even in something that feels so instant, there are technical details. Legally, ownership of the asset might not transfer until 1 or 2 business days later. That's because of exchange settlement rules. But the core idea stays the same. In spot trading, you pay and almost instantly receive. You're not waiting a month, a quarter, or a year. Meanwhile, there's a whole other world, the futures market. That's where delivery is postponed. Like if you agree today to buy oil in 6 months at a fixed price, those are called futures contracts. Stick around. We're going to cover the different types of spot trades and why they matter to every economy. Also, join our Telegram channel where we share new videos and articles. You'll find the links in the description or the pinned comment. Not all spot trades settle at the same speed. There are 3 common settlement types: TOD, TOM, and SPT. TOD stands for today. Same-day settlement. Everything must be finalized before the market closes. TOM stands for tomorrow. Settlement happens the next business day. And then there's the classic, SPT or T+2, which means 2 business days after the trade. For example, if you buy stock on Wednesday, you officially own it on Friday. That's also when the seller receives the money. It's efficient, transparent, and pretty quick. But all parties must have the real assets. You can't just promise to pay later or deliver it tomorrow. You need the cash, and the seller needs the asset. Real deal. And that's the biggest difference from the futures market, where you can enter a contract without having the money or asset on hand. Spot doesn't always mean instant, but it does mean real. You're buying what actually exists. You're selling what you actually have. That's why the spot market is seen as the most honest and transparent. But don't get too relaxed just yet. We're about to explain what a spot price is and why it's more important than you might think. A spot price is the price at which you can buy or sell an asset right now. It's not a forecast, estimate, or promise. It's the real deal. This price is formed at the moment of the transaction based on supply and demand. If everyone's rushing to buy oil, the price goes up. If investors are dumping dollars, the exchange rate drops. These live numbers are what we call spot prices. You can see them in trading terminals, in the order book, or the trade tape. It's like a store shelf. You see the price right there. And not just the asking price, but the one where actual deals have been made. One more thing, the spot price is also a benchmark. Even future contracts, where delivery happens later, are often based on the current spot price. It's like an anchor the whole market uses. Why is that important? Because as a trader or investor, you need to know where prices come from, why they change, and how market behavior impacts them. That knowledge helps you decide to buy, sell, wait, or go all in. And that's not all. In the next part, we'll talk about what types of assets are most often traded on the spot market. You might be surprised. They're everywhere. Spot isn't just about stocks or currencies. It includes commodities like oil, gas, gold, grain. It also covers the crypto world, where spot deals happen in real time. Assets go straight to your wallet. Even the stock market often uses spot settlement. You buy shares and they're delivered almost instantly. Spot is part of everyday life. Every store purchase is a spot deal. Money for goods, pay and receive. Simple, but brilliant. Spot is what keeps the economy running in the here and now. And it's important to know, spot can happen on exchanges and off exchange. On an exchange, trades go through centralized platforms with clear rules and full transparency. Off exchange, it's a deal made directly between two parties. It's flexible but less secure. In crypto, spot trades can happen on centralized and decentralized platforms. On the former, you register, verify your identity, and use the interface to trade. On the latter, you just connect your wallet to a smart contract and go. But either way, you need to have the asset in your wallet. Otherwise, the trade won't happen. One of the biggest reasons spot trading is popular is how easy it is to access. No fancy math, no complex forecasts, no 6-month plans. If you've got money, you can buy. If you've got an asset, you can sell. Spot is all about clarity and speed. The entry barrier is pretty low, especially in the digital world. Sure, commodity exchanges may require minimum amounts, like a ton of oil or a kilogram of gold. But in crypto or stocks, you can start with just a few dollars, plus no strings attached. In spot trading, you're not locked into a time frame like with futures. You can sell in an hour or hold it for years. Totally up to your strategy. For beginners, spot is the perfect launch pad. Like your first bike without gears. Simple mechanics. You feel it instantly. Made a mistake? You see the result right away. Got it right? Lock in your profit and keep going. But watch out, there are pitfalls. So stay tuned, we're about to cover the downsides of the simplest market. Spot trading has its cons. The most obvious, you must have the money or the asset. You can't make a trade without funds in your account or without owning the asset. That means no betting on future growth, no margin trading. If you want to buy 1 Bitcoin, you need enough money for it. If you want to buy 1,000 shares, you pay the full amount up front. Second con, limited hedging options. In futures, you can lock in a price for later. Great for planning. In spot, not so much. Today's price could be different tomorrow. You're fully exposed to market swings. Third, volatility. Yes, it's lower than on the futures market, but that cuts both ways. Less risk, but also less profit potential. If you're looking for fast moves and quick gains, spot might feel a bit dull. And finally, liquidity. Spot relies on matching orders. No buyer, you won't sell. No seller, you can't buy. This is especially tricky in low liquidity markets. So even though it's simple, spot trading should be done wisely. It's not a game, it's a real part of your investment strategy. Check out our website. There's a new article out now. We've got free content on stocks, bonds, and ETFs for everyone from beginners to pros. Save it to your bookmarks. Besides the standard T+2, the SPT mode, traders can also use TOM and TOD. These are especially common in currency markets. TOD means settlement today. Super fast. You buy euros. And by the end of the day, they're in your account. Handy when you need to make urgent payments or transfers. TOM means settlement tomorrow. You make the trade today, the asset lands in your account the next business day. It's great for saving a bit. TOM rates are usually slightly better than TOD. That difference is basically the daily interest rate. Fun fact, the cost of these trades can shift depending on the key interest rate. The higher the rate, the bigger the gap between TOD and TOM. That means there's even room to profit off those differences by switching between modes. In the stock market, SPT is the norm. You buy shares, and 2 business days later, they're yours. But even that has exceptions, especially in crypto and on decentralized platforms. Let's say a company urgently needs 10 tons of oil. It hits the spot market, buys at a price of $7,500 per ton, and gets delivery in 2 business days. No futures, no 6-month contracts, quick and clear, or a business owner importing equipment from Europe. He needs 100,000 euros. He goes to the spot FX market, buys euros at the current rate, and the next day, the money lands in the supplier's account. Deal closed. Transparent and straightforward. Even when you buy a smartphone in a store, you're doing a spot deal, money for goods, instant payment. You get ownership right away. Welcome to the spot world. You've been living in it all along. When you make a spot trade, it feels instant. But in reality, there's a whole lot of technical magic happening behind the scenes. Your order enters the order book and waits for a match. If you're buying, someone else has to be willing to sell at the same price. As soon as there's a match, the trade is confirmed and the money is deducted. Funds and assets get locked. They don't vanish, they're just being transferred. Like handing cash to a courier while your package is still on the way. In a day or two, the asset lands in your account, and only then do you fully own it. This applies to stocks, currencies, crypto, even oil. Everything's automated, but it still takes time. It just looks instant on the surface. If you're a beginner trying to understand how the market works, start with spot. It's simple, transparent, and safe. Fewer levers, fewer confusing contracts, more real assets. If you're an investor looking to buy and hold, spot is perfect. Buy stocks, currency, or crypto, and sleep well knowing it's really yours. If you're a trader, spot gives you a solid base. You can build more complex strategies on top, hedge risk with futures, experiment with arbitrage, test ideas,